And we're live. At the second time of asking, we finally have the Reverend Green with the lead piping in Hugh Hendry's library in St. Bart's. Welcome, Mike, or welcome back, I should say. I gather you have some news for us.
I mean, the news has hit over the past, it's leaked out over the past week. I resigned from Simplify on Monday to launch a new investment firm, Tier 1 Alpha Asset Management, that capitalizes on the work that I've been doing on market structure. We've identified ways to utilize the information associated with passive flows in a unique framework where we're isolating to every individual stock that's positioned us to really start building implementable products. And we'll be making our first announcements on that in the next week or so.
Well, congratulations.
Thank you. As I've talked to Ben repeatedly over this week. When I started doing this work over a decade ago, it very quickly translated into an exceptionally profitable trade, and it's taken me roughly 9 years to figure out the next one. So turns out it wasn't a trade, it's a firm, and we think that there's an extraordinary opportunity to harvest the distortions that are being created by the flows of passive into markets. We think we're in a unique place to do so.
So is it going to be private funds, or there'll be going to be an ETF strategy?
We're going to launch 2 ETFs. We should either register tomorrow or on Monday. I'm not sure which one is going to clear the regulatory hurdle. And we will also be launching SMAs with a focus on delivering excess return with the minimum amount of tracking error versus US large cap equities. We will also be launching an index that should come out by the end of this month that will allow people to see the series history and the methodology all the way back to roughly 2013.
And the key ticker is going to be what?
Well, we can't talk about that now.
Okay.
Compliance means I can't mention it.
Okay.
Goddamn attorneys. Well, the reason that I introduced you with the lead piping is because of your reputation as a plumber. Now, there's been an awful lot of plumbing chicanery going on between the US Treasury and the MOF in Japan this week. I think we should probably start with Japan. Is this intervention going to work?
Well, define work. It will clearly create volatility that reduces elements of the carry trade components where you have seen capital on a hedged basis coming to Japan to take advantage of the much higher interest rates. Perversely, when you run these strategies on a hedged basis, and just very quickly so people are aware, the difference between a US 10-year bond and a Japanese 10-year bond, when you calculate the forward spread differentials in the currency, as well as the difference at the front of their respective curves, which is where financing happens for currency transactions, it means that there is a significant premium to investing in Japanese government bonds relative to US government bonds. You would think that that would strengthen the currency, except of course for the hedge. And so the hedge mechanics actually somewhat front load the currency impact, weakening the currency. And by interjecting a degree of volatility and uncertainty, they're trying to shake people out of these trades. It's just going to be very, very hard to do this unless the respective interest rate policies shift significantly. Either Japan will have to increase short-term interest rates significantly, or the US, which I actually would much prefer to see, will start cutting at the front end of their curve, steepening the surface and destroying elements of that carry trade differential.
Agreed. That's kind of what my view has been on this show, and as you guys know, is like I think it's coming from the US side, but maybe these guys will find Jesus and they'll take real rates, positive or neutral on the call rate.
Yeah, look, we're in a very difficult situation. You have a market fundamentalist bent at both the Fed and to a certain extent at the Treasury, in which they recognize that the markets are sending signals that make it much more difficult for financing both the United States and Japan. Japan has to worry about the FX side of the equation. The United States has to worry about the fiscal impact of high interest rates, as well as the implications that has on the interest rate sensitive components of the US economy. Housing would be the most obvious one, but autos are also quite weak in the United States, the two areas that have the largest consumer finance aspect to them. The Fed is a little bit trapped in Zugzwang, and to use the chess term, in which there's no opportunity to improve your position with the next move. they either are going to have to cut interest rates, which runs the risk of inflating an asset bubble that we're seeing in equities, as well as perversely it will cut the fiscal stimulus that is coming through the higher interest rate channel due to very high levels of debt to GDP versus prior periods. And if they hike interest rates, the interest rate sensitive portions of the economy that are running at extraordinary drops. I mean, it is hard to explain to people how depressed the housing market is. We're running at rates of new home building on a population adjusted basis that candidly we've never seen. This is well below the post-GFC framework in terms of housing per capita. And that, of course, would get even worse if we hiked interest rates higher. We would probably set off a wave of defaults in a variety of forms. We're already starting to see that in some of the own-to-rent category. Airbnb owners are increasingly under pressure due to both changing regulations and higher cost of refinancing. Most commercial mortgages, if you actually were honest in your Airbnb and didn't say you were purchasing it for primary occupancy, have a 5-year adjustable rate component to it. So you're now starting to see those 2020 and 2021 mortgages that were taken on, even some of the 22s that were taken on at discounted rates, are facing the threat of refinance. And even if you are not refinancing, the house next to you is refinancing and therefore runs the risk of coming onto the market in distressed form and creating lower price competition. That's ultimately good for those who are looking for housing, but it is potentially quite catastrophic in terms of the implications that has in clearing prices in housing, which have been remarkably robust relative to what is seen to be a real deterioration in the new build housing markets.
So walk me through the next steps if they do cut at the front. How worried about the back are you?
I'm actually not that worried about the back, because a steepness of the U.S. curve would start to re-attract foreign capital that is currently looking at the differentials and saying, why would I buy U.S. bonds when I can buy Japanese bonds, hedge them back into U.S. dollars? They do not speculate on the yen. This is actually really critical for people to understand. You are hedging your exposure to the yen in that transaction. And as a result, there is a relative shortage of demand for U.S. bonds relative to what we would expect given the absolute level of interest rates. So this is one of the pieces. So as we talk about the last 4 pieces that I wrote on my Substack, the piece that I was highlighting, Made in Japan, which is a pun obviously on cleanup in Japan, the emphasis here is that what we really saw was a marginal buyer, the Japanese life insurance company, hit a threshold in which they could earn in their home country enough to justify no longer investing and taking any form of risk about hedging in US dollars, which has a recurring financing component to it. They can just bring the money home. And that's what we're actually seeing, is that they are reversing that process. And again, because they had reverse hedged historically into yen, that means that there is less impact on the currency than you might actually think. And so these are transactions that were largely yen hedged that are not changing the character of the currency nearly as much as people think. But with US rates now having hit levels that should be very attractive domestically, part of what I think is actually happening is the US Treasury trying to break some of this momentum and effectively draw people back into the United States by saying, hey, this might be a little riskier than you thought it was.
So what flavor of capital repatriation by Japan is yen positive in your view?
I mean, most transactions that happen coming out of developed markets are always going to be currency hedged, right? Your obligations, your expenses are in your local currency. It's very unusual that you'll see a sizable institutional player transacting in a manner in which they are speculating on the currency alongside speculation on the asset. Where you do see that play through, or when components are coming from the rest of the world. Emerging markets, for example, rarely will hedge their exposures back into their home currency. Part of what they're ultimately playing for is a depreciation component in their own currency that is driving them to take capital and put it offshore effectively. Because the rest of the world, the emerging market world, has actually not had that much investable assets, and the war in the Middle East has meaningfully decreased the quantity of cash flow that is currently going through the Saudis and Bahrain, etc., you're creating conditions under which it's hard to see a scenario where there's a ton of capital that wants to invest on an unhedged basis around the globe. At least that's my interpretation of where we sit. The more important point that I would make is that we build all sorts of narratives about bond vigilantes and all sorts of nonsense, right? The simple reality is that there is no bond vigilante that's putting on, saddling up on their horse and strapping on their 2 6-guns and saying, gosh, because the Fed is failing to address, inflation that is rebounded on the back of a war in the Middle East, I'm going to refuse to buy long-dated treasuries in the United States until they get their house in order. It just doesn't work that way. And that really is the key point of the past couple of pieces that I've put out, to say much of what we're seeing is actually just a mechanical byproduct of investment mandates or fiduciary obligations that are created under contractual products like levered ETFs. And that really is the work that sits at the core of the launch of Tier 1 Alpha, is our ability to track those flows on an individual security basis has exploded in the last 9 to 10 months. That is facilitating us pursuing these types of strategies where the primary objective is not what Mike Green thinks, but simply what the flows are mechanically doing.
And Mike, we've talked about this, and I wrote a piece on this. It's not coincidental that we're getting the credit spreads starting to rise in the hyperscalers while we see the JGBs rising, right? Because Norchuk Bank and all these guys have been the major credit players, right?
I think that's right. I also think, though, that there's a really interesting component to this. One of the papers I think I shared with you was a paper that was written around 2022 that evaluates the issuance of super high quality US technology debt as a quasi-sovereign risk-free asset. So basically you had a choice. Would you buy the US bond, or would you buy the Apple bond? Right? And in many ways we saw entities like Apple or Google on occasion trading inside the United States, because there's actually a legitimate question. Would the United States, under leadership like Donald Trump, choose to do the unthinkable as Russia did with Boris Yeltsin in 1998 and default on an obligation in their own currency? Now, I personally think that's absurd, but it is plausible. It is much less likely that under anything other than extraordinary exigent circumstances that Apple would do so. And so in many ways, that capital coming into those bonds was actually seeking, in some ways, diversification risk away from the political concerns in the United States by pushing it into a quasi-sovereign private entity that had effectively no risk of default. As Ben is pointing out, companies like Google have seen their CDS and their credit spreads roughly double over the last 15 months. That's calling into question their ability to opportunistically issue, as they historically did, into markets that are experiencing stress and taking advantage of the low interest rate that is offered during those periods. So there are very fundamental changes that are playing out. And candidly, I think part of what is actually going on is the equivalent of a game of musical chairs. The analogy that I used in Made in Japan was, the Chuck Prince component of the music's playing, you got to get up and dance. That is obviously true for a party, but if you're playing a game of musical chairs, you're doing something very different. Musical chairs, by definition, is a contrived game. How many players do I allow to play? How many seats are being played? How rapid is the music? If you're playing it to Bach or you're playing it to Nirvana, the character of rotation around the chairs is going to be very, very different. And this nonsense that you hear from market fundamentalists like Kevin Warsh is, if we simply stop planning things and stop communicating things, then the market will be free to operate as it wants. But the reality is, it is a game of musical chairs. Every once in a while, policymakers are forced to press the button with long and variable lags of transmission to shutting off the music or turning on the music. And when they're doing that, combined with the organization, how many chairs are there? How many players are there? Who was put on the invite list? What was the music choice, etc.? Those are all things that ultimately mean you can never escape to the idea that a market is anything other than contrived by the regulatory framework around it. which is exactly the point that I keep emphasizing, is why I joined Simplify on a regulatory change in ETFs that facilitated the inclusion of derivative strategies. Now that that has increasingly matured, and I've seen increasingly bad behavior coming through the ETF space on a variety of fronts, and I think that there are unique opportunities for a new firm to launch into that, combined with the intellectual property that we've put together. You find yourself saying it's always about regulations, right? It is always about how we allow the players to play the game, and to consider ourselves exempt from that under some false label of market fundamentalism. It's just absurd.
So what's changed, Mike, in terms of your ability to track these individual security flows in the last sort of 9-10 months that have enabled Tier 1?
So there are two things that happen, right? One is that I personally am guilty of the gambler's curse. So I figured out in 2016, 2017, that the growing role of systematic strategies was creating conditions under which very predictable behaviors that seemed unimaginable under a fundamental framework could occur very quickly under systematic frameworks, where there are things like systematic rebalancing of positions, which the XIV ETF had to do in order to maintain a consistent exposure to the UX futures contracts that underpinned it. The gambler's curse was created because I stepped up to the lottery, to the slot machine, and I won on the very first turn, and I won pretty big. And as a result, there is an element of saying, okay, I got this figured out, right? This is the lucky machine. This is how you play it, etc. And it blinded me, honestly, for almost 9 years to the reality of what had allowed that trade to work. And so, anyone out there who's sitting there saying, hey, Mike Green's a pretty smart guy, understand I spent 9 years hunting in the wilderness to figure out the second trade. Because what I didn't understand was what was unique about the XIV and the inverse VIX complex was that it had an underlier that was effectively a single security. And so the index and the underlying behaved in exactly the same manner. The right way to think about ETFs or index funds is, instead of basically like fire hoses, they are directing liquidity at a series of underlying securities. Imagine crowd control at Kent State, for example. A fire hose turns on, blows at the crowd. Everybody is hit by the fire hose, but some are affected more by it than others. And that's really the breakthrough in our research that happened about 9 months ago, where we started to really dig in and say, wait a second, what would happen if, instead of thinking about it as an ETF or an index, we started thinking about it as 500 individual securities or 1,000 individual securities that are receiving fire hose flows from some very large fire hoses and some minor fire hoses. And that actually perversely requires you to build the capability to track roughly 3,500 ETFs, as well as the underlying securities, identify what flows are coming into each security, and then identify effectively a decay pattern associated with those flows, so that you can identify who is off balance from that last fire hose shot, right? Again, imagine the crowd control scene. If somebody gets hit by the blast of the fire hose and they're off balance, and then they get hit again, they're going to have a much more dramatic reaction than if Frank the Tank is sitting there and he's fully planted and absolutely nothing is going to move him from his position. And so that really was the work that we've done. To give you some idea of the progress that we've made on the technical stack in terms of bringing this in. So again, it requires us ultimately to have about 3,500 individual stocks. We will expand this to the total market index. We've started that process already. We have about 3,500 ETFs of size that are providing liquidity inputs to that. We also track mutual funds and 401k contributions under the same framework. We've built models that allow us to model effectively replicator strategies that allow us to model the behavior of CTAs, vol control strategies, risk parity, to determine where those flows would be coming into futures, and effectively build a signal for each individual stock that says, on an individual stock basis, how sensitive is this to the next dollar that comes in? And if you then look at the predictable components of flow, things that are tied to things like 401ks, et cetera, or the models of CTAs or vol control strategies, you can actually get a very strong sense for what security is going to be, or which securities are going to be most affected by that next influx of capital. Some of those techniques are what you saw us break out in the piece that I wrote around semiconductors, as we tried to understand how much of the move in semiconductors was fundamental and how much of it was a function of vehicles that had been created, like levered ETFs on single stocks or levered ETFs on the industry structure, and how those had influenced the components. Our net conclusion in the case of semiconductors is about 40% of the price move and about 60% of the volatility change was simply tied to the mechanical behaviors associated with the single stock levered ETFs, levered sector ETFs, the introduction of the DRAM ETF, et cetera. And that's a pretty remarkable finding when you think about the magnitude of the move that occurred, to say that you can isolate almost half of it off of just very predictable components.
And Mike, we talked about this with Micron. I mean, like, maybe you can just like share the story about how if the squirrel, me and you decided to have a $5 billion hedge fund, our whole strategy was to buy Micron and then execute in day one. But then there was 90 days where three other guys did it.
Yeah.
Explain that a little bit.
Well, I mean, this was one of the things that we really started working on at Tier 1 as we saw the size of the levered ETF complex grow, and in particular the 3x levered Soxal ETF really took on very different characteristics as the narrative emerged that semiconductors were the future. We actually saw trading strategies in these levered ETFs that are, under any form of logical framework, just absolutely absurd, right? Things like dollar cost averaging into a 3x levered ETF is absolutely a prescription to lose an astonishing amount of money at the volatility levels that we were experiencing. The break even we calculated on the underlying SOX index, given the levels of volatility that existed on the underlying securities, combined with the 3x daily rebalancing feature, which is a vol decay feature, would require the SOX to rise at 154% a year just to break even. Right? Just to break even. Your hurdle rate was 154% annual return on many of the strategies we saw people trading. And as a result, like, that becomes very straightforward. This will not continue, right? It is the, that which cannot go on forever will not. But that sort of mechanical flow, just to dimensionalize it, on any given day, we anticipate roughly $4 billion of net inflow coming into the entire passive complex. Given weights in the indices, make my life simple, and let's say Micron is 0.5% of the S&P 500, that's in the neighborhood of $80 million that would hit Micron in terms of flow. We were seeing flow hit Micron from levered ETF rebalancing, including the 2x levered Micron ETF, that hit in the neighborhood of $5 to $10 billion in a day in a single stock. And so when you start thinking about why you saw these stocks explode, or why SK Hynix or Samsung were suddenly forced to consider listing in the United States to accommodate these elements of flow, it becomes very transparent. We were taking the equivalent, as Benny said, of, if you and I launched an extraordinarily large hedge fund, right, a $5 billion hedge fund, and 100% of our strategy was focused on buying Micron, you would have to do that for 10 consecutive days with 10 additional hedge funds, 9 additional hedge funds being launched to begin to approach the types of flows that we saw on a single security basis.
So with this effect, does the dispersion trade carry on forever? Because this is the absolute nectar of the gods for the dispersion trade.
There are elements of this, and that's also part of what I have realized, and I can talk about some of the things that have hit me as I've gone through this, including some deep self-reflection. But this is what's powering the dispersion trade. These stocks have now become so large that many of them are significantly larger than end markets, right? The South Korea stock market in its totality is smaller than some of the stocks that are listed in the United States at this point. And so perversely, that is what's powering the dispersion trade, is what I would describe as idiosyncratic, non-passive flows. Everybody else is sitting around and saying, hey, can I get a little piece of that $4 billion you're sending? And then a select few are basically being pumped up on heroin through, a needle exchange program.
And so when we think about it, what do you think about the deleveraging event we just saw? And Leopold, the new Catholic Wood, how much has been taken out, you think?
So at one point, we estimated that about half of the decay was done, and at that point, if volatility had retreated, we would have seen a reassertion of passive. One of the things that I think is really critical to understand in that framework is if these products shrink back down and people decide that they want to get away, and more importantly, because the volatility decay component associated with a 3x levered product is so painful, that the capital really just eviscerates. It shows up on Jane Street's income statement. When you have that type of decay, weirdly, it doesn't put that much pressure on the stock. It actually means then that the passive flows can take over and start lifting these stocks back up. And so this is one of the things that I've gone out and commented, is for all of the drama associated with this, you have to assume that a larger fraction of the S&P 500 is going to be represented by these highly volatile, cyclical, commodity-like semiconductors. And overall, that's a downgrade in the quality of the earnings coming out of the S&P 500. Again, Ben and I were talking about this last night. This is reflexivity at work. We have provided capital and we have provided access to markets to these vehicles through mechanical properties that have almost nothing to do with the underlying fundamentals. And it does change the trajectory of history. SK Hynix is able to raise a lot of capital. SpaceX goes public at an absolutely absurd valuation. And what's the very first thing they do? They effectuate an acquisition in stock terms and they issue a ton of debt at very favorable terms. It is now, I think the term is biting people in the butt as they realize that maybe that wasn't the smartest thing to do.
So what derails it then?
Ultimately, what derails it is a reversal of flows, and it doesn't have to be of large magnitude, right? Remember, everything is set at the margin, which is, again, one of the points that I'm emphasizing in the piece Made in Japan. It's markets are determined at the margin, right? You and Ben could own as much Microsoft as you want. But if you are not participating in the next day's trading and I come in and find an opportunity to price it down 30 points, your holdings are going to take a bath unless you become an active player and decide to step in with a counter bid. And you'd be awfully silly, by the way, to offer me a 30% premium to where it's trading to reverse that trade. You would probably step in and buy at that lower price. You'd buy somewhat cautiously because you were uncertain, is there information content in this sudden decline in Microsoft that you might have missed, and you have a market fundamentalist perspective, like something must have happened, I can't immediately step in. And as a result, I, as the marginal player, become the determinant of price. And the same underlying phenomenon will play out if passive vehicles ultimately end up shedding assets. Now, we've seen no sign of that. That's the amazing part, right? And there are two things that are underway. People will point to ETFs as the passive market. Remember that the 401k market is largely dominated by mutual funds. And so products like the Vanguard Total Market Index actually are into redemption mode. They are shrinking in assets, and we are seeing signs that the retirement of baby boomers and a slowdown in hiring rate and rates of adoption of new 401k participants associated with that reduced hiring rate are starting to impact those flows. But we have another S curve, which is basically people saying, all right, that's it. Screw the active managers. I'm not even going to pretend anymore. And you're seeing a very active rotation into ETFs away from active mutual funds. The other thing that is playing out in size is conversion of mutual funds to ETFs, which perversely creates its own bid as well due to the relative time liquidity of the window in which they're trading. A mutual fund clears on a net basis at the end of the day. Right, so Benny, if you decided to buy $1,000 of the Vanguard Total Market Mutual Fund, and the squirrel decided to sell $990, there would only be a $10 order imbalance that would net hit the market. If on the flip side, you each own $1,000 of the Total Market Index in an ETF form, VTI, and the squirrel decides to sell at 11, and you decide to buy at 3:30 p.m., those are two totally different trades that have to be executed into the market, and as a result, the net multiplier of the transition from mutual funds to ETFs actually turns to have a positive and more than unitary sign associated with it as well. And so this is added to the passive impulse that we're ultimately seeing.
Are we thinking about this passive thing as like something that will go on forever, or like what is it that like changes this? You know, like what is the dynamic that how does that go to the next level of like, oh, we reverse it?
I mean, because it is a mechanical system, there are various things we can point to as components of it. I'm not going to attempt to predict exactly what causes it to change. My effort for years has been to raise regulatory awareness of the risks that continued passive share gain create, and basically hope that people were going to do the right thing. That was a misplaced confidence, and candidly, I turned on myself the past couple of days. You know, my oft-stated observation around capitalism. The wonderful thing about capitalism is you don't have to come up with a solution, you just have to pay the person who does. And in many ways, I was deeply misinformed by saying if I make people aware of this, other people are going to come to this fight and start to develop products and strategies that potentially begins to ameliorate it. Regulators might do the right thing and step in front of this. The reality is I was wrong. And so that is, again, part of what Tier 1 is all about, is me saying, well, if I'm a capitalist and I believe ultimately that the solution set exists in human ingenuity, and somebody has to create the product that ultimately begins to tackle these components, it's going to have to be me. And
Mike,
that's it.
why don't you tell them about what you told me at dinner last night about how many academic papers have been versus how many strategies have been pursued?
Yeah, so this was, as we started building the business plan, and we've really focused on industry structure as well as regulatory frameworks and competitive response and everything else in building the business plan. One of the things I was really blown away by was, given the industry's history, how right my expectations were and how wrong they turned out to be in effect. In 1992, when Ken French and Eugene Fama wrote their paper on the value factor, which took dimensional fund advisors from a failing small cap index platform into an extraordinarily dominant platform that at one point held more assets on a relative basis than Vanguard. You saw something like 900 small cap value funds launched between 1992 and 1999. Bob Arnott, who just sold his firm's indexing business at Research Affiliates, introduced fundamental indexing in 2005. And by 2012, it had grown to a $500 billion, peaked at $480 billion licensed index platform that was broadly distributed across almost every vehicle out there. Since 2015, there have been 900 academic papers written on passive impact. Almost all of them find, in accordance with my findings, that there is a sizable and measurable impact. Many of them lack the approaches and techniques we have to refine that even further to increase my confidence much higher. And there have been 0 products launched. Right? It is just extraordinary. Our industry quit. We basically decided to cede the field. And we've been running around, as Eric Balkunas of Bloomberg has very appropriately observed, the more share Vanguard takes, the more hot sauce products are launched in an attempt to basically throw half-cooked spaghetti against the wall and see what sticks. And that has opened up what I think is an extraordinary opportunity to basically say, you know what, let's don the armor and go straight into the center of the field.
Well, that sounds extraordinary, Mike. I mean, I'd love to get a sort of within the bounds of what you can say, a better flavor of what you think you can bring with Tier 1 Alpha in terms of.
Well, so what's really fascinating about it is that it actually boils down to very much like counting cards. And so several times over the past few months, I've been watching movies like 21 just to keep this analogy and this thought process in my mind. it turns out that there is effectively a decay residual associated with the order flow that comes in. And the way to think about it is that there is not just informed traders. There are informed traders who are facilitators. Let's call them drug dealers or market makers. And there are informed traders that are supposed to be correctors, people who have a view on valuation, and presumably when an order comes in from a passive vehicle that carries no information about the forward expected behavior of the stock or the underlying security, that pushes prices up. And thoughtful, informed corrector traders are supposed to respond to that information by pushing prices back down. As that corrector population gets smaller and smaller, their ability to effectuate that change declines. This is actually the subject of an upcoming white paper that I have. It'll be my second white paper with Hari Krishna and Stefan Schubel. And that time period grows, right? So we currently estimate that that is now out to several months. The problem is, it's not just that one order that comes in, right? So on Monday, an order comes in to buy, it pushes it up. It's going to take the reduced size active manager community several months to push it back down. And then on Tuesday, another order from passive comes in, and the active managers have barely had an effect on it, and so it pushes it even further. Right? Now there's two phenomena associated with that. The active managers who moved quickly are now in losses. And another group of people are supposed to come in and say, oh, well, they were just early. I'm going to do the exact same behavior. And then on Wednesday, another order comes in, and that pushes prices even higher. And now everybody's in losses, and the active manager community is licking their wounds and saying, well, do we really want to step in again? If you think about that behavior, the position of every individual security can be thought of almost like a deck of cards, right? We're counting cards. Are there a lot of face cards, or is there a shortage of face cards? And your strategy should be, for any individual stock, becomes how does that how does that individual deck stack up relative to all the other decks that are out there? And so that approach, like, just imagine what we've done. We've got a 3,500 ETF series of hoses that are coming into the machine. We actually have some graphics on this, and it looks like, a guy hooked up to an iron lung in some ways. But you've got all these pipes coming in, and then you're effectively counting each of the, let's say, 500 largest stocks as if they are a deck of cards and saying, I want to bet more on that deck than on another deck. And that process becomes a continuous framework. The amazing thing is, when we pull all market exposure out of that, we estimate that counting process alone adds up to 19% a year, right? And so it is a factor, right? When you think about something like value typically is thought of as offering about a 200 basis point premium. Value is orthogonal, or actually inverse, to many of these metrics. One of the factors that influences how much that deck of cards is influenced is simply size, right? So a large market cap is biased, all else equal, towards more impact from these types of flows. Now think about value. Value is literally fixed book value over that market value. It is in the denominator, and so it has the negative impact associated with it. Value strategies work. They just don't work when they are negatively correlated to a factor that has grown in size that is plus 19% a year as compared to their plus 2. Right? So value underperforming by 1,700 basis points a year would be a base case expectation under this type of framework. Now, I don't think it's quite that extreme, and I don't think that it has, we are at a point where it's ignored. The value factor is probably greater than 2% a year given the valuation discrepancies. And so that spread should be a little bit narrower than that. But you can't expect any manager to survive an 18+% headwind.
So to what extent, Mike, do you think that some of this 19% is being captured by the high-frequency market makers already? I mean, surely that's something that keeps you up at night.
Yeah, so this is the crazy part, is that 19% is the residual. Ben is aware of this, so another paper that we're working on takes the same approach that Lasse Peterson at AQR did with Bill Sharp's The Arithmetic of Active Management, and said, wait, let's examine the assumptions. And so if you think about Grossman-Stiglitz, which is the framework under which everybody articulates that the correctors, the informed traders who are supposed to look at the noise traders and say, that's the wrong price, we're going to push it back towards the right price based on the information that we've paid for. That model is extraordinarily simple in its construction. It has informed traders and it has noise traders. And they are crossed in their trading activity by market makers who, in the models that existed and today still form much of the backbone of the theoretical frameworks that we talk around on this stuff, the official definition of a market maker is a non-rent seeking entity who facilitates trade between two parties. Right? Now that perversely was a little true in the world of specialists, because you actually had a tri-party agreement. You had an agreement with the company that you were going to make sure the stock remained liquid, and you had an agreement with the buyer and the seller that you weren't going to trade ahead of their information. So that put some caps on it. Now, market makers, I'm not lamenting the loss of specialists in that framework, because let's be very clear, they were human beings and they cheated on occasion. And the punitive measures that were taken in the late 1990s to address the revelation that New York Stock Exchange specialists had traded ahead of their customer books for personal profit was to move towards decimalization, the opening up of the monopoly that had historically existed in the New York Stock Exchange, and the order book being given to only one firm for that contractual relationship we talked about before. But that changed the rules in a very material way. And if you look at the world today, it would be very hard to articulate that Jane Street or Citadel are non-rent seeking entities who are behaving in effectively a limited profit capacity. Like that, to me, is the frustration that I have with our industry on the active manager side, and why I think the statistic that all of this work has been done and nobody did anything about it. And again, I blame myself as well, right? Like I sat there saying, you know, if I just provide people with the information, that we'll eventually come to a solution set on this. And it really boiled down to I had to do that as well. I had to, you know, I think the technical term is sack up and put my fortune and my reputation on the line and do something different. And if I'm right, which I believe I am, it becomes a very differentiated platform and really introduces a new category of investing that I'm referring to as passive aware investing.
And let me just talk, or not talk, but like you can tell to our listeners like how this is being received. You know, because like it is a new category, and the squirrel and I know it can be hard to raise money, but like just talk about it.
Well, I mean, I'm not going to talk about specifics, but we are getting a very, very positive response.
Yeah. And so what we're ultimately saying is it's S&P plus, right?
No, S&P is a licensed product, and we have no affiliation or association with it. But we are in the process of launching what we refer to as the U.S. Large Cap Equities Passive Aware Index, and that is ultimately our reference point.
Fair enough. Let's go to your other piece that you just wrote about Japan, and I want to talk about the fact that the market is literally talking about Japan in a way that we haven't seen in a long time, right? And how many Americans and Europeans are aware of the role of Japan?
I think everybody is kind of aware of the Mrs. Watanabe concept and that Japan has sent capital abroad, and the question is what happens when they come back. I just think the narrative that builds up around it is like, oh, the Japanese are going to grow tired of supporting the American consumption habit, and they're going to stop they're going to stop buying our bonds. You know, occasionally people will observe correctly that traders have a high degree of immorality. They certainly are not sitting there saying like, you know, gosh, I'm really angry at Donald Trump and his decision to do X, Y, Z, or Joe Biden did this back in the last term, and therefore the U.S. is on a completely unsustainable path, and therefore we will not buy their bonds. It's not how it works. I wish it was in some ways, because then we could inject a component of morality into it. We could actually have bond vigilantes who occasionally would be elevated, but the simple reality is most of the people in our industry don't have any better ideas than anyone else. And as a result, like I don't really want them setting policy either. It's just the machines. Like, if you are a Japanese insurance company and you have a 2% hurdle rate for your liabilities, and Japan offers 0% returns, you've got to figure out something else to do. Likewise, if you are a Japanese life insurer and you are the thing you figured out to do was go buy U.S. 10-year bonds because they offered you a significant premium over your home market, and you couldn't invest domestically, you'll buy a bunch of those bonds. Now, guess what happens when your central bank decides to hike interest rates to a level that suddenly makes it attractive for you to exceed that 2% threshold in your own home market? So you don't have to take any of the currency risk associated with it, even if you are hedging and you have to restrike those hedges about every 3 months. So there is still risk associated with the currency that you've got to be aware of. But the simple reality is they're going to go home. Was there any morality involved in any of that discussion? Was there a bond vigilante? It's just math, right? And so people will occasionally hear me talk about this stuff as well. But the simple reality is, it's not about morality, right? It's not about disciplining people. All of that went out the window when we moved to passive investing. This is, and other various forms of regulatory frameworks that say insurance companies have to do X. Well, if you tell them insurance companies have to do X and you control the police force that is going to send the insurance company executive to jail if he doesn't do X, guess what he's going to do? He's going to do X. It's just not, we tend to get ourselves all wrapped up in this idea that there are stronger powers and more influential people than us that are somehow controlling the world. And there is an element of that, but they also publish those rules. They're called regulations.
Superb. Well, listen, Mike, I think I'm a bit wary about the recording quality that's going on here. I'm hurting myself a couple of times. So for those of our audience who have stuck with us so far, thank you and bless you. Thank you again for joining Benny and the Squirrel. And hey, listen, on behalf of both of us, best of luck with the new venture. It sounds very exciting.
Thank you very much. I appreciate it.
All right, guys. Well, that's Benny and the Squirrel and the Reverend Green. Out.